Welcome into this week's Monday Market Update. I'm here with Chris Bostic and Ryan Lynch. Last week, retail earnings gave us another look at the health of the U.S. consumer, while interest rates continued climbing towards multi-decade highs. This week, all eyes are on Nvidia and the Jackson Hole Symposium. Chris, on last week's show, you were discussing Walmart. What's your biggest takeaway from last week's retail earnings?
Yeah, for sure. We talked a little bit last week about what we were looking for in terms of earnings from some of the retailers. And Walmart was a big company. I wanted to see what the results of earnings would be, and there was kind of mixed results. There was a beat, right? They beat on earnings. They even increased their guidance, but what the market really seemed to focus on was their U.S. comparable growth number. And essentially, what we saw from that is that exactly what we talked about. There's a little bit of weakening in the consumer. Those numbers miss, and that's what the market paid attention to. And we saw, that day we saw Walmart and even other retailers down quite a bit. And really, this kind of goes along with the theme that we've been talking about is we've been seeing very strong earnings. However, there are other things like the strength of the consumer that the market is going to be hinging on, and we're looking to see what's happening with inflation, how the consumer is continuing to power through that, and are earnings growing fast enough for investors to really want to stay true to being invested in the market at this time. So.
Ryan, Nvidia reports earnings on Wednesday. Has Nvidia become the most important stock in the world, and what will investors be paying most attention to?
Well, it's certainly one of the most important stocks for investors right now because NVIDIA sits at the center of this entire AI investment cycle and really this technological revolution we've been talking about. The company's become a barometer for demand across semiconductors, cloud computing, data centers, and AI infrastructure. But what's interesting is that investors aren't just evaluating NVIDIA anymore. They're evaluating whether companies like Microsoft, Amazon, Meta, Alphabet, Broadcom, continue spending billions of dollars on AI infrastructure and whether those investments eventually translate into the productivity and earnings growth that investors are really looking for. I think the bigger story is whether AI spending evolves from an investment cycle to more of an economic cycle. And if NVIDIA delivers strong results, investors will view it more as a confirmation that this AI build out remains intact. If spending slows, investors may begin questioning some of today's valuations, kind of echoing what Chris said. We've seen great earnings, but really what we need to see is that the forward expectations and the forward guidance really matches these really heightened valuations we've given these companies because of the expected growth.
At the end of the day, Ryan, the expectations are enormous, right? So
Yeah.
we've talked about these great earnings that have been coming out, and in some ways, it's kind of not enough, right?
Yeah.
What investors are really looking for is not only a beat on earnings, but they're really paying attention to guidance, right? They're paying attention to margins. They're really looking for, okay, how is this going to show up? And I think Scott kind of alluded to this last week. We're not really sure, right? Like we're still
Yeah.
so early that it's hard to tell, where are the jobs going to come from, right? Where are the actual revenue streams going to come from? I think there's plenty of them that have not been decided yet. So.
Yeah. And, I think this NVIDIA earnings report's not just like an earnings report for the specific company. It's almost a report card for this entire AI trade and what we see moving forward. So it's going to be fascinating for investors.
While we're talking about AI moving forward, Rye, AI has dominated for years. Are we finally seeing a rotation into other areas of the market?
We've been talking about this the last couple of weeks, and I think when you see longer term broad trends and potential rotations, you're going to continue to talk about it because these things take time. AI leadership, I believe, remains intact, but certainly the conversation's been changing. The first phase of this build out for one of the builders, companies like Nvidia, Broadcom, Microsoft, the ones we just mentioned, really benefited because they were supplying the infrastructure needed to power AI. But I think this next phase and sort of this early rotation we're starting to see may reward the adopters. So what I'm watching closely are companies outside of traditional technology that can start to leverage AI to improve profitability and productivity. Think a company like JP Morgan, biggest American bank, using AI across financial services, United Health improving healthcare operations, Honeywell driving industrial automation, and even some of the logistic companies improving efficiency through data analytics. So the opportunity is expanding beyond just semiconductors, and investors should remember that some of the biggest economic beneficiaries of a new technology aren't always just the companies that invent it, even though they've been incredibly profitable and the stocks have performed really well lately. Sometimes they're companies that use it the most effectively, may be the biggest winners. So I think the next phase and what we're starting to see early is rewarding the adopters and not just the builders.
Chris, we're seeing a real tug of war between the stock market trading around 20 times earnings and bonds offering some of the most attractive yields we've seen in years. Can earning growth continue to support these valuations, or is the market becoming vulnerable here?
Yeah, so fundamentally, we're in a little bit of an interesting spot, right? You mentioned, right now where we're sitting, kind of hovering around market highs, um, but looking at about a 20 times forward earnings is what the S&P is trading at right now. It's above the 5-year average. The 5-year average is somewhere around 19. So yeah, I mean, we would say that sure, the market is expensive right now. On the other hand, the earnings have been supporting it, right? The earnings have been growing into these valuations. And if we look back at the data from the beginning of the year, in the beginning of the year, we were actually trading around 22 times forward earnings. So we've really, in that PE ratio, we've seen the earnings really outpacing the price. So fundamentally, the numbers are getting better. However, if we find ourselves again in this weird category where we've seen now yields, especially on the longer end, right, the 10-year and the 30-year are hovering at decade highs, right? I think that the 30-year hit about 5.25% last week. So now investors are really having to decide, okay, is the market expensive? Okay, if it is expensive, are earnings supporting whether or not I should actually be in the market right now? And then also, is it worth me giving up some of these attractive yields that are in the Treasury that we're seeing in Treasuries, and especially at the longer end? So yeah, there's this tug of war. Investors are trying to find where they fit in. When we talk about long-term investing, to me and in our team in general, we're still bullish on equities, right? We want to be in the market. Again, we're seeing maybe we're paying a little bit of a premium right now at 20 times earnings, but I feel good about even with the market hovering around market highs. I feel good about the fact that those fundamentals are actually getting a little bit better.
I agree with that, Chris. And I think what's interesting too, from a market perspective and from a PE ratio perspective, a lot of the high valuations are coming from a few of the names, but I think we've seen the equal weighting S&P outperform for most of the year, the weighted average. So there's certainly, I think, still a lot of opportunities outside of just the traditional tech that again has carried the market the last few years. So while it is expensive, it's not expensive everywhere. And I think it's starting to become a bit of a stock pickers market rather than just saying, hey, like let's pick these couple tech names that we think are gonna do great and have done great. It helps get some cheaper exposure and then also gets you away from a bit of the yo-yoing we've seen around earnings when these large tech companies report and even if they're crushing earnings, if the forward guidance or AI expenditures offer any potential even yellow flag, the stock sells off a ton and so does the entire industry. I think there's a lot of opportunity there. And then outside of just that, yeah, I think we're going to see a really interesting period of time coming with what we've seen the Treasury do, trying to bring down long-term yields. And then what the Fed is going to guide forward, trying to help the short term to try to get yields to come down and kind of widen that gap a little bit.
Yeah, and you mentioned there's other obviously these large big tech names are the ones that are kind of dominating these huge prices, right?
Mhm.
And I know that it's bigger than just earnings, right? But I think it is important to note. I think last week when I looked at the data, it was about 86% of the S&P 500 companies that had reported for Q2 actually beat on earnings.
Yeah.
So there's strength in the market. There's strength in the S&P 500. Like I said, I feel good even with the market as high and yeah, it's expensive, but I feel as though the earnings are supporting it, and it's still a good place to be long term.
So with Nvidia earnings this week, I could probably guess your answer, but what are you guys watching for this week?
Yeah, I mean that's the big one. I think outside of just a specific earning report, I'm going to be looking at Jackson Hole this week. You have Kevin Warsh delivering his first keynote as Fed chair. This is really important because markets historically look to Jackson Hole to show as a venue of where Fed chairs are introducing major policy ideas. So it'll be interesting to see Warsh's views on inflation, growth, financial conditions, if he has any new policies and how that could potentially change forward guidance. We're going to be looking for clues whether policymakers remain focused on inflation, slowing growth, or rising fiscal risks. So, yeah, I think that's going to be a major thing. And the market may not get policy guidance, but it's certainly going to be looking for policy direction. So I think that Jackson Hole Summit's going to be what I'm watching.
Yeah, Nvidia is big, obviously, but we mentioned last week the Fed and interest rates really are a large macro risk right now to the market. So understanding if we get any commentary or any clues as to what monetary policy might look like moving forward, I think the market in general is going to be looking for, it doesn't necessarily have to be a sharp easing, right? But we're looking for it to gradually decrease, right, over time, and I think that's going to support a stronger market moving forward.
Great. Thank you guys so much for joining us and sharing your insights as always. We'll be here every single Monday to share our insights. You can find us across any of our social channels at ZDTV and ZD Private Wealth.